Hello, my name is Adrian Ashton, and in this hopefully short session on finance and your enterprise, we'll be looking at the subject of what's called profit and loss. Historically, it's sometimes called income and expenditure, but profit and loss is an important concept to wrap our heads around if we're actually to understand how well our business is really doing. Now, just in terms of taking us through this session, to put a bit of context into that, the big question that some of you will probably have who are watching this, particularly if you've already started doing a bit of trading, is I've been trading, I've bought stuff from suppliers, customers have paid me money, there's money in the bank, so that's a good thing. I'm making profit. This is a good venture. Things are going well. Yes, but possibly no, because here in the UK and actually all around the world, we have conventions about how business accounts work, and that has important implications for how we actually understand how well our business is really doing. So what we'll do through this session is to actually clarify why we have these differences in how we approach preparing accounts and what they mean between them. We'll use a worked example to actually try and illustrate the difference between a cash flow in terms of the money in the bank and a profit and loss statement in terms of understanding how profitable your business really is, and then how you can actually use that better to your advantage in keeping control of your business. But firstly, a brief history lesson. And I don't share this image because I think it's cool to do history, although history is cool. Not because I think museums are great places to hang out, because they are. But I wanted to share this with you as a way to try and help explain why we have these different approaches, why we approach costing and pricing in a certain way, why we then approach how we set budgets and manage our cash flow in a certain way, and then how we do this thing called profit and loss, which is different again. And it kind of goes back to this image of what you're seeing on the screen now, a bulla. And it's about 6,500 years old. And what this is one of the earliest known examples of an accounting type system, of how traders kept records of their transactions. Now, I'm not suggesting we all have to go back to school and get the potter's wheel out and make clay balls if we're going to manage our business well. No, no, the reason I share this is to highlight the point that it means that for at least 6,500 years, we globally, as a society, as a species of people, have been figuring out and agreeing the ways in which we do accounts and the way that we do accounting in our respective businesses. Which means that even if once we've got a handle on it and we've grasped it, we think, but surely it would be better if we do it this way. You're probably right. You've got a better idea for how we do it. The difficulty is there's 6,500 years of history that are going to slow that down. So this is just why we have these different approaches, because we've been working on it all as a society for thousands of years. So this is how we're breaking it down. And this is the point of having these short series of sessions, just to help make it a bit more manageable as we go through. So in a previous session, we looked at cash flow and the importance of budgeting cash flow and knowing when money's expecting to come into the bank and when you're expecting to pay bills so that you remain solvent. You can make sure there is always money when you need it to pay the bills, and that when you need to take money out for yourself, because you need to buy some food, you need to pay the rent on your home, you need to pay for your holiday, there is the money there to do that for you as well. And that's really important. It keeps you going. But it doesn't mean you're profitable, because the cash flow considers everything that's going on, considers all of the money that's come in one go and all of the money that comes out in one go. The profit and loss statement actually tries to be a bit more savvy and say, well, let's just focus on what actually happens if we only count what was specifically traded. Take away all the funny money type stuff. If you had any grants, well, that's great. But grants aren't a core part of your ongoing business model. If you took a loan, that's fine too. The money would have come into the bank account, but you wouldn't really expect a business to have to be borrowing money every year to keep going. We just look purely at the trading activity and what's been used in that trading activity, not everything we've bought, but only what we've used of what we've bought. Okay. There's another good reason why we have to do the profit and loss statements, and because it's the law. Okay, that's the boring bit. But let's take you through a worked example just to see how this works in practice to hopefully illustrate it a bit more easily. So what we've got here is we've got a little story, and our story is we're going to set up a market stall, and on our market stall we're going to sell baked beans. Okay. Might not be very adventurous, but bear with me for the purpose of this example. It's simply the MacGuffin. If you wanted to say it was toys from SpongeBob SquarePants, that's equally fine. If you wanted to say it was staplers for stationery, we can use those as well. But in terms of the content we've got today, it's about baked beans. And at the start of the year, when we've set out our pitch, we've gone to the cash and carry and we've brought a tray of 10 beans for 10 pence each. And over the course of the year, we managed to sell 7 of them for 35 pence. Okay, that's the story. If you were looking at us as a market stall, that's what happened if you had a kind of a camera watching it. Now, our cash flow, the position at the bank, this is what happens. At the start of the year, our cash flow would have shown £1 came into our business because we were starting with nothing. We needed some cash to go to the cash and carry with. So we borrowed £1 and spent it at the cash and carry on stock. Okay, money out, money in. So that's what happened. We then had cash. We made cash sales, £2.45 in sales. That's what we took. 7 tins at 35 pence, £2.45 came into the bank. And then we started to pay back some of that loan. Okay, so that £1 that we took out loan, we've started paying it back. And at the end of the year, that means cash in bank, our cash flow is £2.25. Sounds pretty good, right? Yeah, but it doesn't tell the whole story. It only shows what happened with the cash, not what happened as a business model. This is where we move it into the profit and loss statement. So the profit and loss says we only count and we record what was pertinent and actually used in the running of the business. So in that regard, we count sales. We made sales that brought money into the business over the year. Absolutely. £2.45. Ting. From that, we deduct the cost of sales, the variable costs. Okay, now we bought 10 tins of baked beans, but we only sold 7. So we only count the 7 tins we've used. We've still got 3 tins left. We don't count those because we didn't need them. We only count what we used to trade with. So 70 pence comes off for cost of sales. There's other costs in our business as well because we had that loan, remember? And we started to make some payments on it. Any loan usually carries interest. So there's also an interest charge on that loan that we have to deduct. So in the sense of how we set this up, 5 pence. So we paid interest. Now, you'll notice on the cash flow, there's 25 pence on the loan repayment. So why is it only 5 pence here? Because the rules of profit and loss say we only capture what was pertinent to the trading activity. And remember what I said earlier, we assume the profit and loss conventions assume that taking on a loan is not an ongoing activity you're doing every year. Okay, you exist to trade, you don't exist to pay loans back. So under these conventions, you only count the interest because that was the cost of being in business for this year. You don't count the capital element. And in that regard, of that 25 pence you paid back, if you looked at the cash flow and the receipts, that would have shown 20 pence was the capital amount. She paid 1/5 of the loan back, and 5 pence was the interest. And the profit and loss statement says we only count the interest. Okay, so £2.45 sales, because that was the traded income. The costs of running the business are underneath 75 pence, means we made a profit of £1.70. And that's different to this cash position of £2.25. So cash-wise, selling tins of baked beans is a great way to generate cash. Okay, but of that cash, the money that's yours, the profit you've made, is actually £1.70. And there's another rub, of course, which is we've still got some of that loan element to repay back as well. Okay, we've only paid off 25 pence. We've still got 75 pence of the loan to pay back in terms of the interest charges that are going to be accruing on that and the service costs as well. That's where the ideas of a balance sheet comes in. Now, we're not covering balance sheet in this session. We're just focusing on profit and loss. Okay, and this is the key thing. Understanding the cash position is everything that came into the bank, all of the money, all of the types of money, and all of the costs you spent. That shows you how well you're able to pay the bills as you go forward. The profit and loss only captures what is pertinent to the trading you did in that year. You only count what you used because you still got some stuff left over. And when you come to generate a profit and loss statement, or if an accountant or a bookkeeper draws one up for you, this is what they start to look like. At the top here is where the money comes in. Okay, these are the sales we've had as a business. And against that, we take off the cost of sales. And that's, again, the accounting conventions. This is how we prepare profit and loss statements. This gives us what we call the net profit. Okay, net profit is a key figure because that allows us to benchmark how well we're trading. It helps us test, is our profit margin on track to where we thought it would be? If we're buying in stock, if we're buying in material from a wholesaler with a markup that we're putting onto it, how well is that doing? Because then we have the overheads and the fixed costs underneath, and those total those up over the year. So we've really touched upon this idea of interest on loans, finance charges. The other thing that appears in a profit and loss statement is the idea of depreciation. So just to explain depreciation, hopefully easily, depreciation says you run down the cost of an asset, and an asset is something you've bought to help you run your business. Now, in this instance, I always use the example of a helicopter, because I think helicopters are cool, and frankly, who wouldn't want to own a helicopter, right? So in the course of running your business, your cash flow, your bank balance says you've bought a helicopter for £100,000. Okay, so your cash position goes woof, £100,000 goes out of the cash flow straight away. But on the profit and loss statement, you only count what you used. And at the end of this year, the end of the trading year, that helicopter still has usable life left in it. You haven't used it all up in one go. The helicopter has a useful life of, say, 10 years with a bit of TLC. Okay, so that means you've used 1/10 of the helicopter. You've used £1,000 of its value. So on the profit and loss statement, you show that as a depreciation of £1,000 capital items, because you've still got useful life left of that helicopter. You've only used part of its useful life. So the cash flow, all of the money goes out, but the profit and loss helps you understand how much have you used of your stock, how much have you used of your assets, the things that you've bought that have ongoing value, more than 1 year's useful life. And that gives you, well, shown here as a loss, but hopefully a profit, something that says, yes, we made a clear profit. And then from that, that's your money. Okay, that's yours to start to figure out, yep, that's my money. I've understood that. I can use that for my holiday, for a new car, to buy an engagement ring for my fiance, whatever you want, as long as you remember that there may still be some bills you've got to pay. Okay, because the cash flow just says what you've actually bought in and out. The profit and loss says what you've traded over the year. There may still be some odds and ends that's useful to keep an eye on, just to be mindful, particularly if you borrowed any money, because you don't want to get in trouble. So what's the benefit of having a profit and loss statement? It helps you better understand your business. It gives you an overall snapshot picture, because over the year, your cash flow will show money coming in and out in dribs and drabs. The profit and loss pulls it all together and goes, this is your snapshot picture. This is what happened overall. Things that you may not have noticed were racking up because they just happened a little bit at a time. So it helps you spot things that maybe you weren't so much aware of. It helps you test some of your ideas and hopes about the profit you're hoping to make, about the profit margins, how you're setting your prices, how you're managing your costs. So it helps you do some kind of sanity checks and test and reality check-ins against those planning assumptions. All of which ultimately means that you're in a better position to run your business, to understand what's really going on with it, and therefore to be more confident about how you're running it in the future. So that's a quick overview of what profit and loss is about, why we have profit and loss as well as cash flow, and how the two are different to each other, and how we both use them in different ways, but how they're both equally important in helping us understand and run our business. I've been Adrian Ashton. Thanks for listening.